Well, Rivian posted some numbers, and while things are getting slightly better, let's just put it this way, things are only getting slightly better. They are still burning cash hand over fist. Their goal is now to produce 50,000 electric vehicles in a year. They had a goal of 25,000 vehicles. They did slightly miss that goal, coming in at just over 24,000 vehicles. I mean, that's not bad, okay? I don't want to take that away from them. Obviously, they manufacture pickups, SUVs, Amazon vehicles. They mainly blame supply chains as a limiting factor in terms of why they are not able to produce as many vehicles. This comes at the same time as they've stopped disclosing the number of net new pre-orders from customers. That number did stand at about 114,000 as of early November. I actually was one of those people who pre-ordered a Rivian, but now I'm not taking delivery of a Rivian because I'm spending too much money on investing in my businesses. That's okay. I don't need more cars. I think I put 6,000 or 7,000 miles on my car in the last 18 months that I've had the darn thing. So anyway, regarding Rivian, they when it comes to some of their numbers, I think it's just worth going straight to the numbers and seeing what we're facing because, some of the numbers, okay, getting slightly better, but again, we're going to want to pay attention to what is this going to mean long term for the business over at Rivian. Is Rivian the kind of business that you want to invest in? Now, I've been pretty critical of Rivian, not just here on YouTube, but also on Twitter. At one point, I was shorting Rivian. I'm not shorting Rivian right now. I just want to be very transparent about that. But I do want to provide perspective because I do think there are some red flags that if you're an investor in Rivian, you want to pay attention to. If you're not an investor in Rivian, then at least explore some of the things that we're talking about to understand some red flags that you want to pay attention to. So let's jump into, okay, all right, well, the darn iPad's going to be a little funky with the way it displays this again, but that's okay. So what do we have here? We've got the Rivian Q4 shareholder letter, and some of the things to pay attention to is their costs of revenue increased only about 14.4% quarter over quarter. Now, their revenue increased about 23%. That means they're actually expanding their gross margin, which is good. It, in other words, means they're losing less money. Remember this, back in, last quarter, Rivian was spending about $2.71 just to get $1 of revenue. So think about that for a moment. This is not a net income calculation. This has nothing to do with your operating expenses or your advertising or anything. It's literally just to say that Rivian spent $2.71 to be able to get $1 of revenue. That's not ideal, right? Obviously, that's not ideal because it means you're spending a lot of money to be able to get less money. Not ideal, right? There we go, iPad problem fixed. So, what do we have when we keep going or look at this quarter's numbers? We see that loss has fallen. Now we're only looking at about $2.51 lost for every dollar of gross profit they're making. Their net income is even worse. So, obviously the net income is a problem. They're losing a lot of money. They're losing about $1.73 billion. But that's okay. Let's ignore that for a moment. And at least what we're seeing is they're trending towards more profitability, but you've got a long way to go. A lot of people get upset at me because they think, I only care about Tesla. And what they do is they say, hey, well, Tesla in the early days lost money as well. But if you actually go back to 2014, remove any kind of vehicle tax credits that Tesla got, Tesla was still profitable on a gross margin basis. You could go all the way back to 2014 in Tesla, when Tesla produced about 7,700 vehicles. And what you ended up finding was, oh wow, Tesla was profitable in 2014 on a gross profit basis. They were making about $20 for every $100 of revenue with 7,700 vehicles produced without tax credits. So think about that really clearly for a moment. Without tax credits, Tesla managed to make $20 on 8,000 vehicles, about 8,000 vehicles, on $100 spent. So I think the easiest way to visualize that is like this, or rather $100 of revenue equaled $20 gross profit for Tesla in 2014 with about 8K vehicles, right? No credits. That's without credits. It was even better without credits. Today, you have Rivian. $100 of revenue equals $251 of gross loss. Gross loss. Okay, so we're nowhere even close to profitable margin here. at about the same vehicles produced, right? So that's your red flag. That's what you're running against here is, now the Rivian is really beautiful, I have to say. I was just in a Rivian. I went to Redding, California. The realtor was amazing. He showed me his Rivian. I drove in his Rivian. The thing is beautiful. But it looks like the warthog of cars. It's absolutely gorgeous. Like, you look at the car and you're like, please be profitable because I want more Rivians, right? But the problem is it's not. It's not anywhere near close to profitable. And you could see that in the numbers here. Now, I want to show you where they're cutting. But something that I want to remind you when we talk about cutting is the one thing that's not getting cut are the prices and the courses in building your wealth. Today is the last day we're keeping the prices at this flash sale level in honor of Investor Day. We're raising the prices after today in honor of Investor Day. Prices are going up. So if you want to get the best price guaranteed going forward, and this is the same promise we have for people who've bought the course in the past. You can always email us if you think there's an issue. But this is the best price you're going to get going forward. Send us an email at kevin@meetkevin.com if you want to bundle up. But after today, we will be raising the prices on the courses. So if you want to get lifetime access on those for building your wealth in stocks or real estate or my perspective on entrepreneurship, being an employee, real estate agents, YouTube, whatever, check out those courses linked down below. You get lifetime access to any of them, including the course member live streams. Okay, so where they are cutting here, though, is they're cutting OPEX. Quarter over quarter, they cut OPEX 7.2%. Year over year, they over halved OPEX. So they're really trying. They're cutting down their research and development. They've almost halved their research and development year over year. They're cutting down their SG&A, also almost having that year over year. So they're trying, but that cost of goods cost decline is not something I would touch with a 10-foot pole right now. It's very, very scary. I want to see them actually get close to break even. Now, they say in their earnings call, oh, don't worry, we think we're going to be gross margin profitable by 2024. I personally don't believe that. This is their earnings call, and I want to say the highlight moment was, okay, they're talking about bringing on their second shift. Oh yeah, over here. They've got a goal of being gross margin profitable in 2024. I personally highly doubt they can pull that off. Hey, maybe their second shift is going to bring them closer, right? Maybe they can only spend $100 for every $100 of gross profit they bring in, right? That would put them at basically zero margin. That would be fantastic. But right now, they're spending $251 per $100 of revenue on a gross margin basis. That's horrible. It's really, really bad. Now, they have these grandiose visions, and this is where I have a big concern for Rivian, okay? Watch this. So not only do they have these visions of being able to get to profitability, gross margin profitability in 2024, 2025, they think they can fund themselves through 2025. So they're basically trying to say, hey, look, we're not planning on diluting investors. We think we can get to 2025 profitability without having to dilute investors more. That's great. I don't believe it. I'm coughing because I'm allergic to bullshit. But, you know, hey, maybe they can pull it off. But this sounds crazy. They say they see a clear path to 25% gross margin. Like, in other words, by burning $251 per quarter right now, only down from $271 of burn on a gross margin basis per $100 of revenue, they think from that they can go to a profitable $25 per $100 of revenue on a gross margin basis. That's a Tesla kind of target. They think they can achieve that. Hey, if they can, fantastic. But you want to see how they plan to achieve that? And this is where I literally just wrote, what the F, okay? They think that they're going to increase their margin by reducing their costs of goods sold per vehicle made. Okay, hopefully, maybe your second shift will help you with that because right now it's disgusting where you are. I mean, if you sell a car for $80,000, you're spending over $160,000, $170,000 to get that revenue. I mean, think about it. All you have to do is multiply it by 2.5. So their average vehicle selling price is about $800,000 or $80,000. Holy smokes. That means right now it costs them $200,000 to get an $80,000 car off the line. That's insane. That's actually an even easier way to put it. It costs Rivian $200,000 to make an about $80,000 average selling price vehicle right now. Now, I could tell you the exact average selling price. I wrote it down. That was the Q3. I believe I wrote it right here. $82,300 is the current average selling price. So the average selling price right now is $82,300. And they think they can make their vehicles profitable, so somehow bring that gross cost down from $200,000 a vehicle to $82,300. But actually, not just that, they think they can get their costs to 25%, right, or 75%. So they think they can actually get to their goal, which is a fair goal to have, is $61,725 of cost for an $82,300 vehicle. But this is where the WTF moment is for Rivian, okay? You ready for this? They think they can actually improve on their average selling price per vehicle. They're already selling the cars for $82,300. And they think they can raise the prices even more? And what do you want to sell them, like Lucid pricing or something like that, and start selling them for like $200,000 a car? It's insane. I don't know. I don't see it. It seems ludicrous to me. That's Q3 there. Here's Q4. What do we have on actual cash flow? They're burning their free cash flow right now is a negative $4.4 billion. But they do have cash. You know where they got this cash from, folks? From you. If you were a retail investor, they should be sending you a thank you card because they built up an $18 billion cash pile. And in fairness, I'm sorry, that's now down to $11.5 billion. That was the 2021 number. Well, anyway, that's where they got the money from, right? They did a direct listing, they saved on underwriting fees, and they took advantage of retail momentum thinking that this was the next Tesla. And because people thought this was the next Tesla, they threw money hand over fist at the stock, giving the company now what's $11.5 billion in cash left. They've got some inventory, they've got plant, property, and equipment. Fine, that's great. We've got some payables over here of only about $2 billion. They've got maybe some long-term debt over here, so call it $3 billion. They've got free and available cash. I would call it free cash of somewhere around $8 billion. That's fantastic. That should give them about 1.75-ish years before needing to raise money, which is roughly 2025. That's when they actually think they can be gross profitable. That's fantastic. If all things go great, maybe they can pull it off. But let me just say, going from, where's that earnings call? Going from, spending $200,000 on a car that costs $82,300, I don't know, man. Good luck. That's all I'm saying. Good luck, Rivian. And if I were an investor, those are the things I'd be paying attention to. Again, maybe with the second shift, they can get that cost substantially down. Maybe we'll only spend $150,000 a vehicle. It's still a far cry from $82,300. I don't know how much really the second shift is going to make a difference. I get it. You get more vehicles off the line. It should. Is it going to double production? Maybe. I mean, at these numbers, if you were able to double production, in theory, you could get the cost per vehicle down to $100,000. So if you have a perfect scale, right? So in other words, you open up a second shift and you perfectly double production, you're still going to have an increase of COGS, right? Because you have material costs and labor costs that go into it. But let's just say they could double production without doubling costs. Well, okay, then you bring the cost per vehicle down to $100,000. So you're still losing $20,000 on a gross margin basis per vehicle. But you're not going to be able to double it that way because you're going to have increased labor and material costs. So even though you're manufacturing maybe twice as many cars, you're not going to get twice the benefit. So you're still going to be losing $120,000, $130,000 to $150,000 per, or spending $130,000 to $150,000 per $80,000 vehicle. It still does not make sense. The numbers are very, very bad. And all you have to do is go look at Teslas in 2014 when they were manufacturing 8,000 vehicles, and they're not that bad. These numbers are a company that looks like it potentially will never be profitable, and that's scary. They'll probably have to go bankrupt or get acquired by someone else, or raise their prices substantially for their vehicles. I don't see that happening. If they can't raise the prices for the vehicles substantially, then they're potentially on the course of bankruptcy. Or they just start putting less expensive stuff in the cars, but then at that point, if they start cheapening out on the car, which is beautiful right now, absolutely beautiful, some of the stuff they put in the car right now, gorgeous. If they start cheaping out on it, well then why would you buy a Rivian over a Tesla, which Tesla has the autonomy, which Rivian doesn't? Rivian has like adaptive cruise control. It makes no sense to me. I don't know, maybe I'm just like passionately concerned. We'll call it that. I'm like the doctor who's, yelling at somebody who has a terrible diet, trying to say, Would you just eat some salty nuts, please? Like, get some good fats in you. That's just what I feel like right now. I'm not saying they can't survive off, a ribeye and cheesy hamburgers and prime rib dips, but they're probably going to die of a heart attack. Is there a chance they won't? Sure. But they're playing with fire. That's all I'm saying about Rivian, okay? Look, beautiful car. I just want to be so crystal clear because I'm not trying to offend Rivian owners. In fact, you know what? I think if you buy a Rivian, you are getting a $200,000 car for 80 grand. That's the way to look at it. You win if you're the customer at Rivian, unless, of course, there are a bunch of service issues that come up in the future. But assuming that's not an issue, you win if you're a Rivian customer because you are basically robbing Rivian. You are getting an 80 grand car or a $200,000 car basically for 80 grand. You win.